If you are trying to buy your first investment property in your 30s and keep looking at the down payment numbers and thinking it's not possible, you are not wrong about the number. You are actually wrong about which number matters. Most people spend 3 to 5 years saving for 20% down payment. By the time they get there, prices already moved. Rates have changed and they start the clock over. That's not bad luck, that's the wrong strategy. In this video, I'm going to show you the 4 decisions that took me from 1 property to 24. And today, my rental portfolio generates $405,000 gross rental income, completely passive. And finally, I have something special for you today. 90-day action plan if you are here till the end. I will also share with you my Excel template. But before all of that, here is the one important decision you will need to make before buying your first rental property. Get this wrong and you start with the wrong foot in a bad location. Let's talk about the location. Real estate investing advice almost always assumes you are buying near where you live. That assumption is quietly destroying people's returns before they run a single number. In high-cost cities like San Francisco, New York, Seattle, Los Angeles, property prices have moved so far ahead of rents that the math on a rental property simply doesn't work. Same reason I moved out from Seattle. A home that cost $800,000 rents only for $3,500 a month. That's just 0.44% ratio. The deal loses money from day one. Here's what my own portfolio actually looks like. I live in Tennessee now, but all of my properties are in Nebraska, Alabama, Tennessee, and Ohio. You can take a look at my portfolio. This property is in Omaha, Nebraska, same as this one, similar to other few properties. So I have 50% of my portfolio right now in Omaha, Nebraska. And you will find other properties in Euclid, Ohio. This is in Alabama. These all 4 or 5 are in Alabama. And you will find something in Memphis, Tennessee as well. But the interesting thing is that I have never needed to fly out to check out on my properties. I have never managed a repair call myself in the last 5 years. I have a property manager in each market who handles everything. The reason I am in those states is not that I have some special access. It's that those are the markets where the numbers work. Birmingham, Alabama, Omaha, Nebraska, Cleveland, Ohio, and Memphis, Tennessee. In these cities, a $115,000 property rents for $1,300 a month. That's 1.13% ratio. The deal cash flows from day one. The thing about remote investing that stops most people, they think managing a property from a distance is complicated. What's actually complicated is managing a property yourself. Fielding calls at midnight, coordinating repairs, changing late rent. A property manager charges 6 to 8% of the monthly rent. On a property bringing in $1,300 a month, that's close to $100. What do you get with that $100? Someone else handles every single operation in detail. And I'm happy to pay $100 per property for the property management company. Your job is to own the asset, build the compounding machine, and get the cash flow every month. The city you live in is a lifestyle choice. The city you invest in is a financial decision. Those don't have to be the same place. So go to Zillow.com, search Birmingham, Alabama, Omaha, Nebraska, Columbus, Ohio, Memphis, Tennessee. Filter for single family homes between $80,000 to $150,000. Pull Rentometer or Zillow's rent guesstimate. And you are looking for monthly rent that is at least 1% of the purchase price. That filter alone tells you whether a market is worth of your time. If you are in San Francisco or New York, you already know the answer. Knowing the right market cuts out most of the losing deals before you ever open Zillow on a specific listing. That's what this decision does. It gets you to the starting line with numbers that can work. But even in the right market, most first-time investors hit the same wall. They look at what a down payment costs and they stop. If you want to buy investment property out of state, then only you need 20% down payment. But there is a smarter way to overcome this problem if you want to buy property in your hometown. And this is called house hacking. House hacking is when you live in the house and rent out a spare bedroom, basement, or other units inside a duplex. You can start house hacking with an FHA loan. The good thing about FHA loan is it requires only 3.5% down on a primary residence. So on a $200,000 property, that's just $7,000. But here is the catch. It's a real one, is that you have to live in the property for at least 1 year. That's where the strategy comes in. Think about what that actually means for you. You buy a duplex, you live in unit A, you rent unit B, your tenant's rent covers most or all of your mortgage. Isn't that nice? You are not paying $1,250 a month to own a $200,000 property. You are just paying $350. After 12 months, you move out, you rent unit A. Now, both units are generating income, cash flow $300 to $400 a month. Then you do it again with the next property. The FHA program resets every time you move into a new primary residence. So the $7,000 entry point isn't a one-time thing. It's a repeatable loop. So what can you do? Find a duplex in a market where rent on one unit covers at least 70% of your mortgage. Apply for an FHA loan. Check current requirements at hud.gov. Live in unit A for 12 months, move out, rent unit A. Both units now generating income. Use that cash flow to save the next $7,000 down payment. And repeat the whole process. That's how one property becomes 5 without a large lump sum. By the way, if you want my help buying your first investment property, finding the right market, running the numbers, and closing on something that actually cash flows, I work directly with first-time investors to go from zero to a signed lease in 90 days. Book a no-obligation call with me. The link is in the description below. The house hacking loop handles the entry. The FHA structure handles the capital. And now you know which markets to look in. But here's where most first-time investors lose money even with the right financing in the right market. They fall in love with a property before they run the numbers. There are 2 filters that kill bad deals in about 30 seconds. Before you visit the property, before you call an agent, before you waste a weekend on something that was never going to work. Here's what they are. Let's talk about your feelings versus filters. There's a pattern that shows up in almost every bad first investment, and I saw it almost 100 times. Someone finds a property they like, the neighborhood feels right, the house looks good, they can picture tenants in it. Then they run the numbers. Or sometimes they don't even run them at all and they buy it anyway based on their emotion. 6 months later, the property is losing $200 a month and they can't figure out why. The property didn't fail them. The process did. I will walk you through a real deal I did in Memphis, Tennessee. So the purchase price is $115,000. Monthly rent is $1,304. The 1% rule, monthly rent divided by purchase price. So what you do, $1,304 divided by $115,000 equals 1.13%. It passes the 1% rule. Now let's look at the filter 2, the 50% rule. Take a gross rent, $1,304, cut it in half. That is exactly $652, covers all your operating expenses, property taxes, insurance, maintenance, vacancy, and property management. The other $652 has to cover your mortgage payment and still leave something over. At 20% down on $115,000 property, the mortgage is around $552 a month with 6% mortgage rate. So the property cash flow $100 each month. That's the 2 filters doing its job, not killing the deal, but telling me exactly what deals to avoid. What these 2 rules are actually doing is removing the emotional variable from the decision. When you run the 1% rule fast, you are not looking at photos. You are asking one question: does the rent justify the price? If the answer is no, you move on. It takes about just 10 seconds. The 50% rule tells you whether the cash flow is a real after expenses, not the optimistic version where nothing breaks and the property is always occupied. Together, they let you screen 20 properties in an afternoon and walk away with 2 or 3 worth looking at seriously. The feeling comes after the filter, never before. You don't fall in love with the property before running these 2 filters. So go to Zillow.com, pick any low living cost area city, from the list in section 1, take the asking price, remove the last 2 digits, that's your minimum monthly rent. If the market rent is below that number, close that tab. If it passes, take monthly rent, divide by 2, subtract your mortgage payment from what's left. Positive number, what's the deeper loop? Negative, move on. Run the same thing on 10 listings. You will see which markets produce deals and which ones don't. Let me show you my Excel file, how you do it. So here is my Excel file where you put the purchase price, all these blue boxes. You put the renovation cost. If there is nothing, you put 0 here. You put the monthly rent. Right now you can put 1500. For this property, it will be 1304. The purchase price need to be 115,000. You get the monthly mortgage payment and put it in this box. And finally, for this Excel file, you can get the cash on cash return. By the way, if you want my Excel file to calculate this automatically for you, download the file from the link and run the numbers for 10 properties in just 30 minutes. Let's talk about my final strategy. Before the action plan, let me deal with the 3 things I hear most from people sitting on the edge of starting. They ask me always these 3 questions. I don't have enough money to get started. The FHA loan requires $7,000 on a $200,000 duplex. Not $40,000, not $60,000, $7,000. The second question I was asked most, what if the market crashes? My portfolio cash flowed through the COVID in 2020 through a 2022 rate spike that pushed mortgage rates from 3% to 7% and through 2 separate corrections. The rent doesn't stop because the market drops. Your tenant still pays on the first of the month. The mortgage is still a fixed payment. The property still exists. A market crash is a risk to sellers, not to a landlord. The third question people ask me all the time, should I sell once the value goes up? The answer is median US rent has increased roughly 3 to 4% per year for the past 30 years. A property renting for $900 a month today will rent for approximately $1,200 a month in 10 years. That's what the historical data shows. Your mortgage payment doesn't move. You locked in a 30-year fixed rate on day 1. Same payment in a year 10 as year 1. When you sell, you pay capital gains tax. You lose the monthly cash flow. You lose the mortgage pay down your tenant was covering. You lose the future rent increases. Then you have to find somewhere else to put that money and start the compounding clock over from 0 again. I have never sold a high cash flowing rental property, not because I am attached to them. Because the math on holding is almost always better than the math on selling. The compounding is invisible month to month. Over a decade, it's the whole game. And when 2 of my properties gained so much value, what I did 1031 exchange from those 2 properties to 14 properties. And here is my personal story how I get started. 2019, I had $25,000 in savings. I was a software engineer, good job, good salary. My net worth barely moved. I sat in my house one night staring at a property listing, a duplex $25,000 in Cleveland, Ohio. The math worked. I was terrified to click, but I clicked. 1 house became 2, 2 became 4. I wasn't making more money. I wasn't taking bigger risks. I was running the same 4 decisions on each property, one at a time. 24 units later, the portfolio generates $404,000 a year in rental revenue, $1,107 a day, whether I work or not. 6 years, $5 million in real estate, started with just $25,000 and a lot of fear. The fear didn't go away after the first one. It just got smaller each time. The math stayed the same. So here's your promised action plan for you to take in the next 90 days. Week 1 and 2, search Zillow in Birmingham, Alabama, Omaha, Nebraska, Columbus, Ohio, or Memphis, Tennessee. Run the 1% rule on 10 listings. Build the pattern. Week 3 to 4, call 3 local property managers in your target market. Ask what properties are renting for and what vacancy look like. Month 2, get pre-approved for an FHA loan. Know your number before you look at anything specific. Month 2 and 3, find a duplex that passes both filters. Make 1 offer, negotiate to the price where the math works. Month 3, close, move in, start the 12-month clock. You don't need to do all of these at once. You need to do the first thing first. Keep in mind, if you are buying out of state, you need to put 20% down. But if you are buying in your hometown, you can buy only 3.5% down using FHA loan. If you are ready to stop researching and actually buy, and you want someone who has done more than 30 times to walk you through your specific market, your numbers, and your first deal, book a free call with me. The link is in the description below. I work directly with the first-time investors like you to get started.